This one trading pattern transformed my trading and helped me become one of the best traders in the world. I call it the right side of the V. And this concept, which is found all throughout the market, helps me risk less while making way more. In its broadest form, the right side of the V concept helps traders understand that the same price does not always equal the same expected value. This is one of the biggest trader fallacies of all time. A lot of traders assume same price, same result. They see the same number pop up later and think it's the same play. It is not. The pattern and timing change the expected value. Let's assume that if this example stock bounces and goes back to its normal price, you might be able to make 50 cents. But your risk, we're going to give 50 cents as well. That is actually even being generous, because the reality is, when you're fighting the trend, you don't necessarily have a stop. And that's one of the most dangerous parts. We're just going to assume your win rate is 55%, loss rate is 45%. So this does have a very small marginal chance of winning and positive expected value in this case, just based on these assumptions. But we're really going to hammer down what happens when you get the same price after the turn. Once you wait for what I call the right side of the V, once the turn is in, two key changes occur at point B. First of all, now we have a true stop rather than just something arbitrary or uncapped risk because we're going to give it to the lows of the day. The other most important part is that our win rate improves because we're now going with that counter trend as it bounces. Even if we assume it is the same reward to risk, but that our probability of winning is significantly higher, we end up with much better expected value.